The committee will come to order. Without objection, the chair is authorized to declare recess of the committee at any time. And all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. The hearing today is entitled Financial Industry Regulation, the Office of the Comptroller of the Currency. I now recognize myself for 3.5 minutes to give an opening statement. So today we will welcome Joseph Otting, the 31st Comptroller of the Currency, who took his office approximately 7 months ago. We will welcome him for our first appearance before the committee. What a difference 17 months make in the life of a nation, and what a difference public policy makes. Working together with the administration, this Congress has made a huge difference in perhaps produced the most booming economy in many people's lives. Unemployment now is recorded at the lowest in a generation, tied for the lowest in almost a half a century. Also, African American unemployment is the lowest on record, and the gap has narrowed. Last month, there were actually more job openings than there were unemployed. It's the first time since record-keeping began in the year 2000 that has occurred. After years and years and years of press reports that unemployed people are seeking factories, we now have press reports that factories are struggling to find workers instead. We have reports of robust wage growth as well, the best wage growth in 11 years, and in the last wage report, 49 of 50 states had positive wage growth. The National Federation of Insurance Business has said the highest number of businesses are increasing worker pay that they have ever recorded in their survey. University of Michigan reports that consumer confidence is at the highest level in 14 years, and even the New York Times has had to admit, quote, the economy is humming. Again, this did not happen by accident. It is a result of the Tax Cut and Jobs Act and the effort, particularly of the administration and our banking regulators, to right-size regulation, to properly calibrate regulation, to ensure that it is working for working people, because all regulation, regardless of its intent, regardless of its purpose, can ultimately have a cost on access and cost to credit of hard-working Americans. And so it is an incredible achievement that once again we are seeing average 3% economic growth. And that's so important because when one looks at the data, one sees that in American history, the greatest employment, probably almost 80% of job gains, of income gains, of poverty reduction take place in 3% growth years. And so how wonderful it is to have regulators who are committed to growth in our economy. And so, again, the greatest boost to our economy is not a government economic stimulus plan. It is not quantitative easing. But it is business confidence that comes from good public policy and smart regulatory efforts. So I look forward to hearing from our witness. I know that he has been quite active on a number of fronts, including fintech charters and Volcker and BSA and AML. I look forward to getting into all of that and seeing what is it we can do to make sure that 3% economic growth continues for all working Americans. The chair now recognizes the ranking member of the committee, the gentlelady from California, for 5 minutes for an opening statement.
Thank you, Mr. Chairman. I'm looking forward to hearing Comptroller Otting's testimony and asking him about his activities at and plans for the Office of the Comptroller of the Currency. Mr. Chairman, I believe that Congress has a responsibility to ensure that our economy and laws work fairly for everyone. And yet, at a time when banks are posting record profits, the Trump administration and its allies in Congress have taken banking regulation in this country in the wrong direction. Last month, congressional Republicans pushed through 2155, the legislation was championed and signed into law by Donald Trump, who made an early promise to, quote, do a big number, quote, unquote, on Dodd-Frank. S-2155 rolled back protections Democrats put in place following the 2008 financial crisis to strengthen oversight of Wall Street and ensure that risky activities do not bring down the economy again. Since taking office, the Trump administration has consistently taken actions that hurt Main Street and benefit Wall Street. Mick Mulvaney, who was illegally installed as acting director of the Consumer Financial Protection Bureau, or by Trump, is hard at work weakening the agency from the inside. His latest act of anti-consumer aggression was to fire all 25 members of the Consumer Bureau's Consumer Advisory Board and then to insult them on their way out the door. It's in this context that we have Comptroller Otting here before us today. Testifying here for the first time, American public has the right to know if he plans to follow in the deregulatory and anti-consumer footsteps of this administration. I'm particularly interested in hearing his perspectives on the direction in which he will guide the OCC on three important issues: the Community Reinvestment Act, the opening of fraudulent accounts by our nation's banks, and the regulation of the fintech industry. It has been widely reported that the federal banking agencies, including the OCC, plan to update their implementation of the Community Reinvestment Act, that is CRA. I agree that the CRA could benefit from modernization to reflect the changing banking landscape, which now includes online banking, which is not solely based on brick and mortar bank branches, but any modernization process must not be focused on making CRA exams easier for banks. 99% of banks already receive a passing grade from regulators on their exams. Rather, any update to the implementation of the law must be focused on ensuring that banks are responsibly meeting the credit needs of their communities. A recent report by Reveal News found modern-day redlining, the discriminatory practice where minority communities are denied mortgage loans and have less access to credit across 61 metropolitan areas in our country. That is unacceptable. So it is absolutely critical that the CRA, which was designed to combat redlining, is not weakened to let banks off the hook from their obligations. I'm also very concerned regarding reports that the OCC has found that more banks open accounts without the consent of their customers. In a review conducted following Wells Fargo's egregious fraudulent account scandal, I'm looking forward to hearing from Comptroller Otting today on the details of the OCC's findings on this subject and their plans to prevent such practices moving forward. I would also like to hear the Comptroller's views on fintech and the way that technology is rapidly changing the banking landscape and how the OCC is responding. As Americans are banking and accessing credit in new ways in this market, it is important that we encourage responsible innovation and also that we ensure that fintech companies are providing credit fairly to all communities. I yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, chairman of our Financial Institutions Subcommittee, for 1.5 minutes.
Thank you, Mr. Chairman. Comptroller Otting, thank you very much for joining us today, and I can't tell you how great it is to have somebody that actually has banking experience running the OCC. Welcome. As a former banker and bank examiner, I felt incredible frustration over the last 8 years. We experienced failed economic policies that led to the slowest recovery in the modern era and a regulatory pendulum that swung too far to after the financial crisis. Our financial system needs stability, it needs rigorous supervision, but also needs certainty. Institutions need clear rules of the road. Despite a recent financial renaissance and changes at the most senior levels of government, I remain concerned that there are legacy supervisory issues that need to be addressed. That's particularly true when we look at the troubling trend of de-risking, which is still an issue I hear about on a near weekly basis. I urge you to take steps to ensure that the decisions you make are clearly communicated to the field and that OCC examiners use their positions to promote safety and soundness in our financial system and not to advance any sort of political agenda. With your leadership and experience, I'm confident that we will be witness to a more effective and responsible supervisory regime, one that upholds rule of law rather than thumbing its nose at it. My colleagues and I thank you for being here today and for taking on this responsibility. Look forward to your testimony. And with that, Mr. Chairman, I yield back the balance of my time.
Gentleman Yoldzak. Today we welcome the testimony of the Honorable Joseph M. Otting, Comptroller of the Currency. Again, this is the first time that Mr. Otting has appeared before this committee, as he was sworn in again as the 31st Comptroller of the Currency on November 27th of last year. Mr. Otting holds a Bachelor of Arts in Management from the University of Northern Iowa and is a graduate of the School of Credit and Financial Management, which was held at Dartmouth College in New Hampshire. Mr. Otting brings to the job a wealth of banking experience. Prior to becoming Comptroller, Mr. Otting was, again, a longtime executive in the banking industry. He served as president of CIT Bank and co-president of CIT Group from August 2015 to December of 2015. He also was president, chief executive officer, and a member of the board of directors of One West Bank. Without objection, the witness's written statement will be made part of the record. Mr. Otting, you are now recognized for 5 minutes to give an oral presentation of your testimony, and again, welcome to the committee. But you are going to have to turn on your microphone.
Thank you very much. Good morning, everybody. Chairman Hinzerling, Ranking Member Waters, and members of the committee, thank you for the opportunity to share my priorities as Comptroller of the Currency and my views on reducing unnecessary regulatory burden and promoting economic growth. The Office of the Comptroller of the Currency mission is to ensure our federal banking system operates in a safe and sound manner, provides fair access, treats their customers fairly, and complies with applicable laws and regulations. We accomplish that mission and rationalize our regulatory framework so that the system can create more jobs and economic opportunity. My written testimony details the conditions of the federal banking system, risks facing that system, and my priorities. These priorities include modernizing the Community Reinvestment Act to increase lending, investment, and financial education to where it is needed most, and encouraging banks to meet short-term, small-dollar credit needs to provide consumers with an additional safe, affordable, and credit choices. My priorities also include enhancing the Bank Security Act and anti-money laundering compliance so that banks can provide a more effective means to support law enforcement and comply with statutory and regulatory requirements more efficiently. I also support simplifying regulatory capital requirements, recalibrating the VOCA rule, and ensuring that agencies operate effectively and efficiently. Today, I also want to discuss the importance and quality of the work accomplished at the OCC. Since becoming Comptroller, I've been struck by the professionalism and caliber of the agency staff. The agency's 4,000 employees serve our nation by performing the important task of supervising more than 1,300 national banks, federal savings associations, and federal branches of foreign banks. While the vast majority of institutions we oversee are small community banks, the system also includes the largest, most globally active banks in our country. Successful supervision requires a corps of professionals supported by lawyers, economists, information technology specialists, policy experts, and many others. Few Americans know the OCC, but the majority of them have a relationship with at least one of the banks we supervise. It is not an overstatement to say our nation's banking system is the most respected in the world, due in large part to the quality of the supervision the OCC provides. The OCC is unique among federal banking regulators. It is the sole regulator exclusively dedicated to prudential supervision. Undistracted by multiple mandates, we maintain a laser focus on bank safety, soundness, and compliance. The agency takes a risk-based approach to supervision, tailoring its oversight to the risk and business models of each individual bank. At the same time, its broad national perspective provides value in identifying the risks and concerns that may face similar banks or the broader system. Our risk-based approach allows us to adapt the economic opportunity and continue core safeguards necessary to protect the safety and soundness of our financial system and prevent consumer abuse. I am fully committed to implementing the changes in the law as quickly as possible. I will work with my fellow regulators on a collaborative interagency basis where appropriate. Where existing rules may conflict with the Economic Growth Act, where the statute provides transition periods, or where the law requires agency rulemaking for implementation, the OCC plans to supervise institutions consistent with the intent of the law, including with respect to amendments to the stress testing requirements, and will not enforce requirements on banks that the bill intends to eliminate. As a bank executive, I relied heavily on the judgment, expertise, and counsel of the OCC examiners. They helped me identify issues and address them effectively before the concerns turned into serious problems. I felt the OCC examiners understood what we as bankers were trying to achieve, and we worked to meet the financial needs of our customers. I slept better knowing that the OCC supervised my bank, and you can sleep better knowing that the men and women of the OCC are on the job overseeing the national banking system. In closing, I want to congratulate you, Chairman Hensley, on your leadership of this committee, and thank you again for allowing me to share my perspective as Comptroller. I look forward to answering your questions.
Thank you. The chair now yields himself 5 minutes for questions. So, Mr. Otting, we all know prior to your tenure, Wells Fargo ripped off far too many people for far too long a period of time. The OCC launched a horizontal review of all retail bank sales practices after the Wells Fargo scandal. And by the way, I hope and believe the new Wells Fargo management is still in the process of cleaning up prior messes. But the question has occurred, what has happened on this horizontal review? How extensive was it? There hasn't been a public report, some press reports. So my question is, how extensive has the review been? How long did it take? How many banks were examined? And what are the takeaways from that? And what can be presented to the public? And what is still part of a confidential supervisory matter? If you'd please comment on this.
Thank you very much for the question. In 2016, the OCC launched a horizontal review. We concluded that examination in the fourth quarter of 2017. More than 40 national banks were involved in the look back. We looked at the new account opening activities in the following areas: mortgages, auto, credit card, checking, savings, and money market. This look back was a 3-year period that included hundreds of millions of new accounts each year, which on a 3-year basis probably was somewhere between 500 and 600 million accounts. We concluded that, as I said, in the fourth quarter. On June 4th, we sent letters to the bank CEOs wrapping up the horizontal review. On June 11th, we sent letters to the chairman and ranking members of Congress to provide you an overview. I'm here to report today that we did not find pervasive or systemic issues in regards to improper account openings. We did find the needs for banks to improve their policies, procedures, and controls. With this, we issued 252 matters requiring attention, and 20% of those have been closed, with the remaining being under supervisory review. Through this entire process, we found less than 20,000 accounts out of the hundreds and hundreds of activities of the opening of new accounts, with less than half of that 20,000 being due to unauthorized account openings. So we feel that this report is conclusive. We feel there is ways for banks to improve their policies, procedures, and controls, but at no point in time did we find pervasive or systemic items associated with this review.
So, Mr. Otting, how long did the review take?
The review took roughly 18 months.
It took 18 months, and how many personnel were involved? I mean, how would we look upon, how extensive was this review?
We call these horizontal reviews. It virtually, I couldn't give you the exact number in the agency, but it was the #1 issue over the last 18 months in the agency that we took most of our examination staff to focus on.
And did I understand you to say that there are roughly 500 to 600 million bank accounts within the federal banking system?
No, those are the accounts that have been opened over the last 3 years.
Just opened over the last 3 years?
That's correct.
And you, out of that universe, this horizontal review found roughly 20,000 questionable.
We found 20,000 accounts that we felt half of those were due to unauthorized account openings. The point that I would make here is that, as we've gone in, we didn't find, good documented policies and procedures associated with the account openings. And so the core takeaway from this is banks are working on through the MRAs, and matters requiring attention are very consistent in the industry when we go in and examine things that we don't think are up to a certain standard, that we'll issue an MRA. And the key takeaway here is that we're asking banks to improve their policies, procedures, and controls around account openings.
Thank you, Mr. Comptroller. As you well know, on May 24th, right before Memorial Day, the President signed into law the Economic Growth, Regulatory Relief, and Consumer Protection Act, which was a bipartisan bill in both the House and the Senate, largely viewed as the most pro-growth banking bill in a generation since Graham Leach Bliley. But it does direct the OCC and other federal regulators to change its rules, undertake rule makings. Can you outline the schedule to implement this law?
Yes, we've quickly assembled resources within the OCC, and we are looking, the rule or the legislation from three particular ways. One is what can we quickly implement? Second bucket is what requires a rule for us to write, and the third is what will require coordination amongst the federal agencies. And so I would tell you that we are actively on it right now, trying to create critical paths to accomplishment, but it is receiving the highest priority in the agency.
That's what I like to hear, Mr. Comptroller. Otherwise, my time has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee, for 5 minutes.
Thank you, Mr. Chairman. Comptroller Otting, I'd like to ask you about the horizontal review of bank sales practices that you conducted in the wake of the Wells Fargo fake accounts scandal. You said in your letter that you sent on Monday that this review included more than 40 banks, and you said that the review identified a staggering 250 deficiencies that required the OEC to issue matters requiring attention to the banks on review. That's an average of over 6 matters requiring attention per bank. So my question is, did you find problems at every one of the banks included in the review?
Ma'am, what I would say to you is, first of all, I don't view it as staggering using that word.
But just answer my question, please. My time is very limited.
I know 250 out of 4,000 MRAs that are currently involved in the industry. When we observe...
Did you find something in every single bank?
I don't have the details of that in front of me.
How many of those 40 banks had problems that you identified?
When we issue an MRA, it's an item that we ask people to take specific action, and we give that to them in writing.
Okay, so let me follow up on that. If you found over 250 problems at just 40 banks in your review, doesn't that suggest that you should expand the review to all banks supervised by the OCC now that you've identified such widespread problems?
Yeah, you continue to use the word problem, and I would say that we do.
I would say opening up
MRA
fake
positive.
accounts is a problem. I would say that's a big problem to consumers.
But you're correlating with the MRA with opening accounts, and I think that's a false way to look at it.
Well, your letter indicated that you did, in fact, find individual banks that had opened accounts for customers without their consent. That's what Wells Fargo did. They opened fake accounts for their customers. So let me ask you, have you taken any public enforcement actions as a result of your review of sales practices?
We have not taken a public, these are confidential supervisory activities that we have in place that we will track adherence with the MRA activity.
So let me get this straight. Your examiners found evidence that there were banks that had opened accounts for customers without their consent, and you decided not to take any public enforcement actions against them, instead gave them a warning. I have to say I find that deeply disturbing, especially in light of the Wells Fargo scandal, but let's move on. You said that your agency is going to make a decision soon about whether to allow financial technology firms to obtain a special national charter. As you know, the so-called Fintech Charter that your predecessor proposed would have allowed fintech companies to operate with a national charter without being subject to the same regulations and supervisory regime that banks are subjected to. And this was concerning to many of us on this committee. I was also very concerned about preempting all the state laws for fintech companies, which the OCC's proposal would do. If your agency moves forward with a fintech charter, will fintech companies be subjected to the same supervision and regulation of banks?
They would be subject to the same supervision of national banks.
But not federal banks. It would have the same supervision.
That's correct.
All right. Thank you. I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, chairman of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman. Mr. Otting, I read both your testimony and the OCC bulletin on short-term, small-dollar installment loans. Quite frankly, I'm left a little bit puzzled over some of the language you used, specifically by mention of applicability of state laws. I read this to infer that the OCC is retreating from strong preemption, which would be a major shift in policy. Can you please clarify your position and the position of your agency?
Yes, we are not retreating from preemption. It wasn't intended to confer that we would require national banks to adhere to the interest rates of each individual state, but the interest rate to which they are headquartered.
Okay, so you're basically saying that you still have preemption, but you're saying that there are, in certain instances, state laws that are applicable that would still be there.
Well, no, the state laws are applicable to interest rates based upon where the banks are headquartered. So that's the concept,
Right.
that if we misinterpreted that in either our bulletin or letter, we would have to provide clarification to that.
Okay, I was certainly concerned about the way I read that, but I appreciate your clarification. Okay, with regards to another issue, I sent to you this morning a letter that outlined my concerns over guidance being treated by examiners as creating binding obligations on financial institutions. Essentially, examiners are treating guidance as rule without subjecting anything to the process outlined in the congressional review process. Are you willing to communicate to your exam force that, in the words of Federal Reserve Chairman Jay Powell and Vice Chairman Randy Quarles, rules are rules and guidance is guidance?
Not only would I be willing to do that, I have done that since I've been at the agency. We've issued memos within the agencies to make sure that all examiners are aware of that, and so I'm fully supportive. The agency issues Q&A and guidance from time to time internally, and we clearly, our people recognize that, as you said, rules are rules and guidance is guidance.
One of the concerns is, as you well know, that especially happened at the CPB during Dr. Cordaway's reign, that we would have guidance and then enforce that and wind up being a rule or law out of that. And so I think it's important that if you can do this when you're trying to explain the guidance as guidance, also have in there something that would really clarify to the banks that this is guidance, and if you decide not to adhere to the guidance or to vary from that, there will be no punitive action taken, because I think that is a real concern of the financial industry from the standpoint of how things have been done in the past. So if that would be a great clarification and added addition to put with your guidance.
Great. We'll take that under advisement. I know you made that recommendation.
Thank you very much. Also, Chairman Pierce and I have a piece of legislation that's that we've been working on here to modernize BSA AML. And you've outlined in your testimony the need for some reforms. Can you elaborate on why you think modernization of BSA AML is necessary?
Yes, I would. First of all, I would say, everybody would not want bad money and bad people to take those items into the banking system and exit them. And so we've designed a system today with BSA AML, which is very labor intensive, very paper intensive. We produce 10 million pieces of paperwork in the national banks today. And I'm not sure all that effort is really getting to our ability to catch those bad people. And so I think that we have made 14 recommendations to FinCEN. There's an interagency group of people trying to work to alleviate some of the, I think, over-regulatory burden on banks. I know you have some that in your bill that we're supportive of. And we think a collective effort can hopefully allow us to move to a spot where we can be better at detecting bad activity while lessening the burden to financial institutions.
Yeah, as I've talked to a lot of banks about this, they with their CTRs and SARs, they're literally giving millions and millions of documents to FinCEN, and it takes thousands, literally thousands of people to prepare those documents. And so if you think about it a little bit, it's going to take thousands of people to actually look at those documents. So it begs the question, are they even looked at? Are they even reviewed? So I mean, if they're spending all this money and all this time and having all these people do this, there has to be some sort of benefit from it. I really don't see that at this point. So this is one of the reasons we're working on this. And so also beneficial ownership is a very controversial part of this. Can you explain a little bit if you think that do you have a plan to change the definition or to give some sort of delay before implementing, or it's been implemented?
On beneficial ownership, I think it has its merits. I think the issue of having that data readily available is very problematic for the banking industry, and I think we're going to have to work through those issues.
Thank you. I see my time is up. I yield back. Thank you, Mr. Chairman.
Gentleman yields back. Chair now recognizes the gentleman from New York, Mr. Meeks.
Thank you, Mr. Chairman. Mr. Comptroller, I am somewhat, favorable of fintechs. I think that they could be some good into availability into communities of color, et cetera. And I'm glad that the OCC recently came out with strong language against abusive charters schemes there. The sole goal is to evade state law. And I share your views that bank-fintech partnerships, as I said, there are benefits, but there still seems to be some legal uncertainty on the difference between legitimate partnerships and sham relationships. So what I want to know is, what's your opinion on the difference between the two? And will the OCC come out with guidance, specific guidance, to clearly distinguish between true partnerships and rent-a-charter schemes? Because to me, if we don't, the bad can hurt the good and the potential that I think fintechs have. So can you give us an indication of how you see it and what the OCC's role will be?
Yes, Congressman Meeks, I appreciate your interest in this. I know when I was in your office and we had a chance to discuss this, I think this is an important part of the evolution of banking in America today. I would add a third equation to your point, which is how vendors are coming in and helping financial institutions to reach more customers. As a general rule, we have looked, when you say bad or sham or people renting the charter, we've generally looked at where financial institutions, where they're actually using their underwriting and putting those loans on their books. We don't view someone who can channel or referral those opportunities to the bank as a sham, but we definitely hold the banks responsible to evaluate those relationships, make sure customers are being treated fairly. I think where most of the activity in the future will be into where they will use those people as vendors, where they have a great portal or a great way to reach customers, and the bank has a desire to achieve those customers, and then we will hold those financial institutions to their vendor standards.
So will you come out with some clear guidance? That's what I think it needs. If the OCC would come out with some clear guidance that individuals can understand and see, and then we would be able to really determine shams from non-shams. So do you think you will come out with some actual language?
We actually talked about this yesterday at the agency. There was 20-some people around the room, and it was an area we spent a lot of dialogue. We would be happy to involve your staff. I think it's something that will be needed, and we'd be happy to come out with some thoughts on, what is a true vendor relationship, what is a true relationship, and we'd welcome you and your staff's input in that.
I look forward to working with that, because I think that's absolutely key and essential. The potential is there, but it can easily be destroyed if it goes the wrong way, and I think guidance will help that. You also talked about, and I'm interested in, CRA and the role that fair lending should play in CRA examinations. And as you know, and I'll try to do this real quickly, there's basically like 3 thoughts. One interpretation is that fair lending violations should always impact the CRA rating. Another one is that fair lending reviews are sometimes relevant to CRA examinations. And the third, of course, is that CRA examinations are completely separate and have no difference on each other. I know where I am. Where are you?
I'm probably somewhere in the middle. As you know, CRA never included, fair lending components. It was, is the bank serving the community, the entire community to which they operate, with a general emphasis today on low to moderate income communities. But I don't see how a bank, personally, who is not doing fair lending can't have some impact.
Right, because it's important to note that, one of the founding reasons that when CRA was enacted was because of redlining.
That's right.
And the unfair, cutting out districts, and therefore it was not fair lending.
Yep.
And so that, to me, should be very much a part of one CRA ratings. Because if there's discrimination going on, that's a problem. And CRA is supposed to help to be inclusive therein.
Right.
Correct? So I would hope that we look at that very, very, very closely. I don't think I have time for another question because there's somebody over there that's going to bang a gavel on me, and and you won't have time to answer, so I yield back.
Gentleman yields back his 3 seconds. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, chairman of our Capital Markets Subcommittee.
Thank you, Comptroller. Appreciate you being here. I'm going to move quickly because I've got a number of things. Just first and foremost, is increasing liquidity in markets important?
Absolutely.
And has the Volcker rule, as it sits today, impaired that liquidity, especially in times of stress? Could you bend your microphone a little closer to you?
I don't think we've been in a time of stress to be able to test that, to be honest with you.
But as you look forward to it, this concentration, is that possibility there?
It could have the potential.
Okay. So to be clear, have important market-making functions been unacceptably chilled by how the Volcker rule has been both drafted and implemented?
I don't believe so.
Okay. Now, the OCC and other regulators tasked with the Volcker rule implementation have proposed some changes while still implementing Section 619 of the Volcker rule. I think you had used the word, your support, recalibrating the Volcker rule. And I'm curious, how do these reforms clarify or streamline or encourage more efficiencies in marketplaces?
So in our notice of proposed rulemaking, which I'm sure you've seen, we had taken the under 10 billion and had fragmented between $1 billion and less and made assumed compliance. Then 1 to 10 billion, we said if there was 25 billion or less, and over 10 billion, we would go to accounting methodology for that. And what I meant by that is we can look at this accounting methodology to look at individual trades to see if there was proprietary trading. That brings great clarity, both, I think, to the financial institutions and the examiners. Because of where we've been, we haven't been able to issue, I think, good examination guidelines on how to provide overview to proprietary trading.
Okay, well, while we're on that, though, under the current regulatory framework, Volcker-affected entities might encounter Volcker-related examinations from multiple regulators, such as yourself, who have different legal supervision and enforcement regimes, and who might not, frankly, traditionally regulate them. And this committee has heard instances of Volcker-affected entities receiving conflicting guidance from multiple regulators on this. And does a regulatory framework that results in industry participants not knowing what regulators to listen to in order to even comply? I mean, you're talking about bringing clarity, but we still have this alphabet soup of regulators that are out there at times giving conflicting direction, correct?
I think that's been the case, and I think it was, I would say, a pretty remarkable task in a short period of time that we were able to bring the 5 agencies together and agree on a path forward. And I would hope in the future that would eliminate the situation that you're describing.
Well, I think it has to. I mean,
I would agree.
Has that been a goal, is to harmonize?
Yes.
How have you been doing that?
Well, I think it starts with that we all agree now what the rules should look like. And it, we sent that out for comments. If we can implement that with the provisions of the Economic Act, I think that will create that harmonization.
Okay. Would the regulatory framework be simpler if the primary regulator for Volcker-affected entities was charged with examining the entity's compliance with the Volcker rule?
Would, but I think the problem you have is really between the Fed and the OCC, we split kind of evenly those activities. So I think if you said...
Are you kindly saying it's a bit of a turf war?
No, I don't. It's not a turf war
Okay.
at all. It's like where those activities are within that financial institution. Some entities do it in the bank, some do it in the holding company, and so it's split evenly. So if you asked my recommendation, I would say, I would suggest that the Fed and the OCC, where most of that activity is domiciled, could partner to provide the rules or the feedback.
And so let me pursue this, because this is where the rubber hits the road. How are you working with the Fed then to do that?
We have an excellent relationship. Randy Quarles has been an incredible partner since he has been put in that role.
And you're meeting regularly?
We meet every week. The FDIC, Randy Quarles and myself are on a conference call, and once a month we meet for lunch. And any issues amongst the regulatory agencies are discussed. There's an open forum.
Well, I want to encourage that, and anything that we can do to make sure that that happens, because frankly, this committee needs to look at what those next steps are to make sure that that harmonization is happening, and whether it's taken care of in-house with yourselves or whether we need to be involved in that, it will happen. So thank you. I yield back.
Gentleman yields back. The chair now recognizes the ranking member for 5 minutes.
Thank you very much. President Trump supported both the Volcker rule and reimposing Glass-Steagall on the campaign trail, but the administration has quickly backed away from those positions and is now pursuing Wall Street's agenda to roll back the Volcker rule. Do you support the Volcker rule's prohibition on proprietary trading so that banks that benefit from the federal safety net do not gamble with deposits? And additionally, why did the OCC join with other regulators to propose a major overhaul to basically undermine the Volcker rule, making life easier for very profitable Wall Street banks and opening the door to risky trading practices?
I do support the Volcker rule. I don't think our actions opened the door to risky trading. I think it brought clarity to what was defined and the ability to measure and monitor activities within the banks.
When we debated a recent piece of legislation, I think there was some talk about the community banks and the fact that community banks were being penalized in some way because they had to basically follow the rules of the bigger banks as it relates to Volcker. Do you have some discussion on that? Because my understanding, of course, is that the community banks were not involved in the kind of trading that they would have to be concerned about the Volcker rule.
Yes, in the notice for proposed rulemaking we put out before the Economic Act was approved, we assumed compliance for all financial institutions $1 billion or below, and between $1 and $10 billion, we excluded those that had net earnings on trading of 25 million or below. So it was our viewpoint. We agree with you. I'm not aware of any small community bank that's active in proprietary trading.
In addition to that, I'd like to get your take on the fintech. I don't know, since I've been gone, whether or not some other people have talked about it. We have met with some of the leaders in the fintech community, trying to understand exactly how they see going forward and what they understand about the expectations from OCC and members of Congress. Have you gotten deeply involved with fintech and what your predecessor was attempting to do prior to leaving?
I have been directly involved. We publicly said that in July we will make a decision about whether we will accept applications for fintech. But if I could just take 10 seconds of your time, the world has changed dramatically over the last 2 years since Comptroller Curry went out. Fintechs used to think that they wanted to be banks, and now most are realizing because of the capital, liquidity, and commitment to the community they have to provide, they really don't want to be, most don't want to be banks anymore, but they want to be providers of services to banks. And so we see more and more coming in and talking to us about how they partnership with banks to be able to provide portals and things where they can reach customers. So while some will still want to be banks, more and more are moving towards saying, I want to partner with banks and offer our services.
So this participation with banks that you're alluding to, how do they see that working?
Well, like often these fintechs have great portals or ways that they can approach certain communities. With generally credit is a big driver of that they think they can help banks reach into communities, and then they will use that to funnel opportunities to the financial institutions. And generally the fintechs didn't have the capital and liquidity to be able to do that. And so what you're finding is a lot of small banks don't have that technology tool. And the analogy I would use, in the 60s and 70s, most banks used to do their own data processing and have their own computers. And now they outsource that. And so the interior parts of banks are being done by large FIS and various other. I think you're going to see the next evolution is where banks will use various fintechs to help them approach the marketplace to get customers.
Thank you very much, and I give back the balance of my time.
Gentlelady yields back. Chair now recognizes the gentleman from Wisconsin, Mr. Duffy, Chairman of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman, and Mr. Otting, welcome to the Financial Services Committee. I'm back here in the back row if you can't find me. I'm the only one besides the chairman back here on our side. Want to talk about small dollar lending. I think this happens all across America, but especially in rural America, people come into hard times. And in times of need, if they don't have a relative to borrow money from, or if they don't have a knee-breaking Vinny down the street, they're in tough shape. And I know you put out a bulletin encouraging banks to make responsible short-term small dollar loans that are amortized in equal payments. I commend you for that, and I know that you recognize this, but 63% of Americans don't have enough in their savings account to cover a $500 emergency expense. So making sure that Americans have access in times of need is incredibly important. There weren't a lot of specifics, though, on your bulletin. Do you anticipate that you are going to provide guidance in regard to the bulletin?
We do not plan to issue guidance. It was our intention to signal to financial institutions that we are supportive of them entering that space. Most of them design products, and then we will, through our examination process, determine that what they're doing is fair and safe. So we've given the latitude of financial institutions to enter that space with, indications that.
And if it's not fair and safe, then what happens?
Then we would examine that and make a determination if consumers are receiving
Doesn't it make sense to give them some guidance, though? Doesn't it make sense to offer guidance? Instead of saying, listen, we want you to do it, but if you do it wrong, our jaws are going to clamp around you.
Yeah, I don't think that would be the case. What we want to do is the banks to be creative in that space and to look at ways to serve their community. And I'm afraid, personally, if we issued some guidance, we may be too restrictive.
Okay. Obviously, people are concerned about, we are concerned about individuals and families who have low credit scores.
Yep.
And when they access these small dollar loans, their rates are high. But isn't there normally a correlation between, risk and a rate of return?
Yes, sir.
And are you going to be able to change what's happening in the current industry, whether it's the current short-term lenders or the payday lenders? Are we going to be able to change that if we go through credit unions and banks?
First of all, just clarification, there's two product segments in here. There's the up to 45 days and there's a 46 days and above, and we were addressing the 46 days above. I personally feel that one of the reasons this was a big initiative of mine is that we forced banks out of that space in 2013, and for the life of me, on a supply and demand basis, if you take a big segment of supply out, what generally happened is the consumers got the raw end of that deal. And by getting banks back in that space, I think they get fair, more economically efficient for them pricing on loans and there's more supply. But more importantly is the banks have to use that as a stair step if they perform well on those to report to the credit agencies that then they can get back into the mainstream of banking. And that's another one of my clear goals.
And I would agree with that goal. I think it's important. I want to switch gears on you in my minute and a half. I have received more questions recently about an idea that would transition our post offices into a new banking system. Some have complained that rural America doesn't have enough banks or credit unions. I would share that concern, but the problem is we have so many rules and regulations, our small banks and credit unions can't survive. So they go out of business or they have to consolidate. And so the regulation and laws that have come from this town have caused a problem. And so we're now going to come up with a new solution, which is post offices and banking. Good idea or bad idea?
I think it's a creative idea if it increases the ability for consumers to have access to financial services. I'm supportive of most activities that would.
So the government should be involved in lending. We say, listen,
No, I'm not saying that. I said it's a creative idea. I'm supportive
so
of
we're
trying to
talking
figure
about
out.
government lending, Mr. Otting, right? I mean, we're talking about the federal government is going to step in and lend through our post offices. You like that idea?
Generally not, but my viewpoint is I think you have to increase the supply. If there's an
Is there not enough supply right now?
There's not enough supply right now.
And so do you think political lending is a good thing?
Do I think what lending is?
Political lending. That if we make decisions based on politics, and whether it's in housing or in student loans or in just everyday lending, is that a good thing for the American economy and the American consumer?
I think my own personal viewpoint is if we can educate people about financial services and that they can go to their phone and they can get a loan or they can make a deposit or they can open up a checking account, that's a better alternative.
Fundamentally disagree.
Time of the gentleman has expired. The chair now recognizes the gentleman from Massachusetts, Mr. Capuano.
Thank you, Mr. Chairman, and thank you, Mr. Otting, for being here. Mr. Otting, I don't know you at all, and I just want to ask you a few questions generally what you believe in. Do you believe that home ownership is probably the most firm and sound and most used way for relatively poor or moderately poor working class people to move into the middle class? Do you believe that assessment?
I do, but I wouldn't say all.
Not all, but it's the best way. I mean, you're talking to one of them who did that.
Right.
Every bit of middle class ability I have is because I bought a house 30 years ago and stayed there. At the same time, do you believe that discrimination, either, never mind the legal obvious one, but even institutional discrimination, do you believe discrimination exists in America today?
I have personally never observed it, but many of my friends from the inner city across America will tell me that it is evident today.
Do you believe that it exists?
I believe it. Like I said, I have never personally observed it. People have told me it exists, and so I trust those people when they tell me that.
So you believe it exists? I understand you've never, and you're very lucky that you've never experienced it.
That's right.
Do you believe that it exists?
Here's what I would say. I believe the people who tell me that it exists.
So discrimination in America exists today?
Again, I stand by my answer.
Well, that means you probably don't believe a lot of things because you haven't personally experienced nuclear war either, so does nuclear war exist? I mean, I'm not going to get into that. That's a ridiculous answer, but that's okay. Do you believe that discrimination exists along racial, ethnic, gender, socioeconomic lines?
I, again, have never observed that, but people who are close to me have said that they have experienced that.
You've never experienced it. Have you ever read about it?
Yes, I've read about it.
Do you believe that the writers are stating a truth or just using it for political purposes?
My experience with writers are they're right half the time.
So there's no discrimination in America?
No, I'm not saying that.
What are you saying?
Huh? I'm saying that I have personally never observed it.
Geez, I don't even know how to respond to that, if you want the truth. I think you finally got me.
That wasn't my intent.
Well, it was okay. Not too many people can get me. I just, certain things stun me. Do you believe in America today that economic disparity exists?
I do believe that.
Do you believe it's expanding or do you believe it's not expanding? The difference between the wealthy and the poor.
I believe that it is not expanding now with what we're seeing with employment and economic opportunities in America.
You do not believe that the rich are getting richer and the poor are getting poorer.
I think what I was saying is I believe that people on the lower economics end of the society are seeing more economic opportunities with jobs.
That's not my question. I asked very simply, are the wealthy getting wealthier and the poor
I
getting
don't have those
poorer?
statistics in front of me, so I can't answer that question.
I really think you need to get out a little bit more, Mr. Otting, and again, you can disagree with it. I understand there are people that disagree with it. That's why I'm trying to assess your beliefs. Awfully hard to ask you questions if I don't know what you believe in. Then I have to go right back to what I think.
Invite me over
of
to
the-
your office, and I'll come by and we can have.
No, you're welcome to come by anytime, but, you know, this is a public hearing that I kind of figured I'd ask some questions, but I guess I have to just revert to what I think of the Trump administration then, if you refuse to answer me questions about what you believe, because I do believe discrimination exists. I do believe economic disparity is growing. I didn't blame you, I didn't blame the Trump administration, but I believe it exists, and I do believe it's expanding. Last year, do you agree or disagree with the Wall Street Journal's assessment that the OCC made it harder, this is a quote, made it harder for banks to be penalized under the CRA? Do you agree or disagree with that statement?
I disagree with that statement.
Great. So the Wall Street Journal, the well-known pro-business magazine newspaper of the world, is wrong in their assessment about business. When you were at Hanover, did you ever eat at Lou's?
No, I did not. I
All
went
right.
to, I ate at.
You know where Lou's is?
I don't. I ate at the Hanover Inn.
Well, Lou's is right down the street. It's where working class people in. The Hanover Inn is where the alumni in. That's where they eat. When you're in school, you eat at Lou's because you generally don't have enough money to eat at the Hanover Inn, but I'm glad you did. When you were at the Hanover Inn, did you observe the speed limit along South Main Street?
I did not drive.
It was about 30 miles an hour. Do you know that there were some people there? I guess I'm going to run out of time, and I'm going to give it up because I got to give you credit, Mr. Otting. You got me. Never having seen discrimination. You're a very lucky man.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Missouri, Ms. Wagner, chair of our Oversight and Investigations Subcommittee.
Thank you, Chairman Henserling. Comptroller Otting, I'm over here. Mr. Emmer, thank you. I know that the OCC is working on reevaluating the Community Reinvestment Act, as is the U.S. Treasury Department. So let me start there. In past remarks, you noted, and I quote, community groups don't like the way CRA is today. The banks don't like the way CRA is today. The regulators don't like it. In addition, Treasury Secretary Mnuchin said at a hearing just last June, banks, I quote again, banks spend billions and billions and billions of dollars fulfilling their CRA obligations. I want to make sure it is absolutely going to help communities and isn't just to check the box to satisfy regulators. Comptroller, what is the OCC's overlying diagnosis of the problems with the CRA?
I think there are three core problems that we'd like to solve for. One is we need a more objective way to measure a bank's success in CRA. Today we have a very subjective points process. I've been putting forth an ability to look at a balance sheet item that either is deposits, total assets, or Tier 1 capital, add up all the activities that a bank does, and an example of that of $100 million of CRA at a $1 billion bank, they'd be at 10%. We could apply that universally across the industry, and it would be easy to understand a bank's commitment to CRA. Second of all, today we have a very narrow description of where people are doing their CRA activities, and it's predominantly residential mortgages and multifamily and low to moderate income areas. I think we need to expand the definition of what qualifies. I think we have a cap on $1 million of a revenue for a small loan. In East Los Angeles, if a company is $1.5 million in revenue and creating 30 jobs, then I think that should qualify. I also know the difference between state and church. But in the Black and Latino communities in America, that's where people go for job counseling. That's where they go for, helping them get ahead. And so when the minute a church is identified with a CRA thing, it's disqualified. I think that part.
And the third, because I've got other questions.
And the third is we have a process where we do examinations every 3 years. It takes us 6 to 24 months to complete the exam. If we can fix the first one where we can be more economic, we can almost perpetually be able to say a bank is in compliance with their CRA activities.
Sounds like there are many areas and avenues of reform and betterment to actually reach these communities that have occurred since
I
the
would agree.
1970s. In your spring 2018 rulemaking agenda, you provided that the date of May 2018 as the anticipated date for an advance notice of proposed rulemaking, that ANPR, for the CRA reforms, but we still have not seen anything as of today, Comptroller. When do you expect the OCC to finalize its recommendations for that ANPR?
I get up every day trying to advance that ANPR.
Time frame?
A lesson learned of coming to Washington, D.C. is you put yourself out there a little bit, and I would tell you, I am hopeful now in the next couple of weeks that we can get that out.
Next couple of weeks, that's great. Well, we look forward to it
Thank you
also.
so does everybody else in America.
Does the OCC have plans to issue in conjunction with other agencies, and what has been the OCC's involvement with other federal agencies and financial regulators to this point?
It's been an attempt to be a multi-agency effort. The OCC has been ready since March to issue the ANPR, and we're hopeful that we can make this a joint agency action.
Do you anticipate any major differences between the Treasury report and the OCC's vision for CRA reform? And if so, what are they and why?
I do not. I followed the Treasury closely. Obviously, Secretary Mnuchin and I teamed up to have a CRA plan. We worked within the confines of the CRA, and we're both very energetic about creating more opportunities for banks to serve low to moderate income areas across America.
What areas for CRA reform can be accomplished primarily through agency rulemaking and guidance, and what areas of CRA reform will require congressional legislation, do you think?
100% can be done through the agencies.
Wow, that's fantastic. Well, as chairman of the Oversight and Investigation Committee, I look forward to your report. I look forward to reforms that perhaps have been decades and decades overdue, and bringing this up to date to make sure that we're taking good care of our low and moderate communities and giving them the chance at the American dream. I thank you for your hard work on this, Comptroller. Mr. Chairman, I'm about to run out of time, and I yield back.
Gentlelady yields back. Chair now recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman, and thank you, Mr. Comptroller, for helping the committee with its work. I want to go back to the chairman's earlier question and also Ms. Maloney's. In response to the Wells Fargo situation where Wells Fargo actually robbed their own customers by opening up accounts and charging them fees for which they were not authorized to do so, we had this horizontal review that you described in your opening remarks, 40 banks, and it's your estimate, based on that there are about 20,000 questionable cases. I was wondering, these 40 banks, is it fair to assume that some of them had strong new account policies?
I would say yes.
Some did not, right?
That's correct. And it wasn't that we found violations, it was that there wasn't specific policies that were part of their risk management process. So I want to just be clear.
Yeah, I understand what an MRA is, a matter requiring attention. I understand that. But here's what I'm getting at. Our goal is to try to hold the bad actors accountable if possible. And so you did this whole study, and then you never named anybody, even though you found 20,000 or 10,000, I guess, were without authorization, but 20,000 cases in general. How do we hold people accountable when you treat the good guys, and you say there are some people that had strong policies, the same as the ones that had less so? It's just, we're trying to hold people accountable. I think by doing the investigation and then not holding people accountable publicly is creating a moral hazard. We did the right thing with respect to Wells Fargo with the fines and all that, and went after them. But I just think in that industry, there's a lot of Me Tooism, and you'll see activities in one bank, if they're successful, will be copied by other banks. And I'm not seeing, an approach from OCC that would curtail other banks from following in this type of conduct if we're not going to hold them responsible.
I don't think you can say that the institutions did not hold the individuals responsible. There were actions with certain employees, and I think, does that mean that you announce which employees were being?
I guess what I'm saying is hold them publicly
Yeah,
responsible.
So I think I mentioned in my comments that we're currently under supervisory activities and we're following these MRAs.
Okay.
And so to announce these during that process, I think would be
Okay,
inappropriate.
fair enough. No, that's a good point. Let me ask you, there's some talk about amending, reforming the Bank Secrecy Act, and there's talk specifically about reducing the amount of information. I'm talking about CTRs and cash transaction reports and suspicious transaction reports that go to FinCEN. What do you think about that?
I think it should be open for review. There's 9 million CTRs that are produced today from the national banks, and the viewpoint, the question, it's $10,000. I think we produce a lot of paper, and I'm not sure it gets to the point where we're catching the right people. Often businesses that have been banks for a long period of time get caught structuring at that lower dollar amount.
Yeah.
And so, there's an estimate that 20 to 25% of those are good American citizens with businesses trying to move money back into the system illegally, and they get caught in that current lower level of CTR.
Yeah. Well, I trust you're talking with FinCEN?
We are. We have a joint...
We talked to, just so you know, we, on the committee, we've sat with the Financial Crimes Network, and they expressed a need for the data. It gives them if you're looking for a needle in a haystack, you need the haystack in terms of what they look for. So I am just cautious about doing that. We got a lot of bipartisan interest in protecting our banks and making sure that people of nefarious intent do not abuse that for terrorist purposes or money laundering. And I advise you or caution you to share that caution with us in terms of making it easier for someone perhaps to use the legitimate banking system for terrorism or money laundering purposes.
Yeah. Congressman Lynch, I agree with you. I think there's some things around the edge that we can improve. But the long term, I think, is how we take a database of all the transactions and make that available to law enforcement. And what we're finding when there's some pilots doing that, the hit rates are much higher, and there's all the less of that other activity. You may be familiar with some of those.
I am. Thank you, Mr. Chairman. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Kentucky, Mr. Barr, chairman of our Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman, and Mr. Otting, welcome to the committee. Good to see you this morning. Your predecessor began an effort to provide special purpose charters to fintech companies, as you know, and my understanding that a number of critical policy questions remain unanswered. Will you commit to ensure that the public, including Congress, has an opportunity to weigh in on these critical questions?
We have been on a process to review whether we would issue a special purpose charter in July, and that is the track that we're on at this point in time. I would be happy to work with your staff or any other members of Congress that would like me to come by and have some dialogue on that topic.
That'd be great. I appreciate that. We'd like to know what the OCC is thinking on this topic and what types of fintech companies might be eligible for such a charter. Obviously, there's been much debate and discussion concerning fintech lenders and the challenges of serving a national marketplace with a 50-state patchwork of confusing and conflicting state regulations. And this includes the topic of the OCC Fintech Charter, yet multi-state focused brick and mortar-based lending offices, which also use financial technology, seem to have been left out when discussing solutions and the need to modernize regulations. These so-called click-to-brick lenders cover a market segment that online lenders cannot fully serve, especially for those consumers who have the greatest need for more hands-on underwriting and servicing. And these consumers include many hardworking families as well as entrepreneurs and small business startups. So it seems to me that we need, to the extent that the OCC does move forward on a national charter, that we would need a comprehensive approach so that we don't leave out important market segments. that continue to struggle with an antiquated regulatory model. How can the OCC, or any federal regulator for that matter, address the need for modernization of the non-bank lending regulatory environment, especially for those delivering their services across multiple state lines and having to contend with this patchwork of conflicting and sometimes contradictory regulations?
So, Congressman Barr, regarding non-bank, that is generally not an area that the OCC is involved in, the Bureau is involved in that. Those that would want to become a bank, through any kind of charter application would have to go through, capital, liquidity, and serving their community. So I think, to answer your question, I'm not sure I'm, in a position to do that.
So is it your position that the OCC is not the appropriate regulator for non-depository institutions? If Congress, for example, were to offer that opportunity for you to expand your regulatory jurisdiction, would that be something that you would say would be outside of the expertise or capabilities of your agency?
I wouldn't say it's outside the expertise, and I do think, Senator Barr, that some fintechs will elect not to have deposit-taking capabilities. They'll fund through another source, and we do think that some of those institutions have sufficient liquidity and capital to do that.
Well, to the extent that there would be a national charter, whether it would be OCC or the Bureau or another regulator,
Well, the Bureau would not have the authority to issue a charter.
under current law, correct, right. Would it be important in terms of leveling the playing field with an optional national charter to include not just the click-to-click, but also the click-to-brick, so-called click-to-brick? Would that, in your mind, be an appropriate response to addressing the national charter concept?
That they could apply for a national banking charter, yes.
And obviously, the special purpose fintech charter has received, lukewarm interest because of a number of factors, including the threat of litigation from states and the fact that a charter won't offer the ability to raise cost-effective funding through deposits. But at the same time, the special purpose charter would offer substantial benefits in preempting these conflicting state laws. If the OCC does not move forward with a charter, what can it do to support innovators that make loans over the internet and either have an interest in becoming a bank or partnering with a bank?
So a number of the state banking agencies have been in to talk to us, and a lot of them are trying to create coalitions where they can standardize the state banking laws. We see that with the MSBs, with a number of states coming together and standardizing their MSB laws. So if somebody wants to operate in multiple states, they don't just have one choice, which is a national banking charter, but they can actually operate within those states with common laws.
Thank you. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Sherman.
Mr. Chairman, I'd like to respond just a little bit to the economic picture you painted in your opening statement. And I focus on annual statistics. Monthly statistics just jump up and down. In terms of jobs, since Dodd-Frank became effective or was enacted, the first full year was 2011, we have had 7 years of strong economic growth. And we've created in that 7 years 17 million new jobs. 2 million of them created while Mr. Trump was in the White House. That's 2 out of 17. Economic growth last year was 2.3%. That is somewhat lower than the average of the prior 3 years. It is still good to have some economic growth. We look forward to higher levels of economic growth. And of course, our trade deficit with China last year was at an all-time high of $375 billion. We all hope that America is successful, but in evaluating a presidency, a president like President Obama, who inherited a plane that was headed careening toward the ground and turns it around so it's headed up, deserves substantial credit. A president who inherits a national economy that is on its way up and is able to continue that increase at perhaps a slightly lower rate than he inherited does not thereby win a Nobel Prize. I will ask Comptroller Otting, back when I was young, banks didn't always just lend to AAA-rated giant institutions. They took some risks. They didn't take risks on subprime, financially engineered, super default swap Baru things. They lent to the small businesses in our community. They didn't even get a government guarantee to do it. And in order to take those risks, they charged prime plus 2, prime plus 3, prime plus 4 on loans to smaller businesses because there's always a 1 or 2% chance that such a business goes under. In more recent times, banks have been able to take enormous and catastrophic risks on the giant financially engineered products, but they tell me that they're constrained in taking the moderate risk associated with a loan to a local pizzeria unless they can get it SBA approved. How will your auditors react if they see that a bank has 5 or 10% of its portfolio lent to small businesses in its community at rates of prime plus 3 or prime plus 4, precisely because those very businesses have a credit risk that justifies a prime plus 4 loan? Can they devote a chunk of their portfolio to that kind of loan, or is it basically a world in which they can't take those kinds of risks?
As long as it's within their risk tolerance that they, in their risk statement, then the examiners would, not offer any issues associated with that portfolio.
Within their risk, I've been told by every small bank officer that I've talked to that if they had prime plus 4 loans, your folks would come down on them very, very hard. Do you find that banks are able to make non-government guaranteed loans without demanding the owner pledge his or her house to small businesses?
Well, loans are made based upon a primary and secondary source of repayment, and that's the way the risk rating is determined. So if a small business has cash flow that can cover their obligations plus...
What if the business's economic position was such that it would be fair to charge them prime plus 4, even prime plus 5? Does that disqualify? That means that there's some risk with the loan.
Pricing is not the factor when we're looking at the safety and soundness of loan. It's
so basically you're saying the loan has to
there has to be a primary and secondary source of repayment on the loan.
And if there's a 5% risk or a 2% risk that it will not be repaid according to its terms, what do your people do?
You're saying the loss given defaults and the losses associated with that loan? Is that what you're saying?
I'm saying that there's a significant risk that the loan will not be repaid according to its terms. The 2 to 5% risk that such will occur.
I think it would be the level of reserves that someone has against that particular loan based upon the expected default and loss factor.
Time of the gentleman has expired. The chair now recognizes the gentleman from Florida, Mr. Ross. I'm not sure your microphone's on, Mr. Ross.
Thank you, Chairman. When it comes to CRAs, and I was just reviewing your testimony again, you note in your testimony that stakeholders involved are extremely dissatisfied with both process and results. What is the underlying problem with CRAs? I also note that you mentioned in there about incentivizing banks to take more interest in their neighborhoods. And as we move to more and more online banking and less branch banking, my concern is that there are neighborhoods, communities under the CRA that are going to be overlooked, and I know you've addressed this, and so my first question is what's the problem with the CRA as we know it today with allowing for this incentive for banks?
Yeah, I'm not sure I said incentives for banks.
Encourage banks. Encourage. You use the word encourage. I'm sorry.
So I think today we have a subjective way that we measure banks' success under CRA. Second of all, we have a very narrow product that's being deployed to achieve CRA results. And the third issue is that we have a very complex examination process every 3 years that's difficult to turn that around.
When do you think they're going to begin, that the OCC will begin its formal process for revising the CRA on behalf of national?
I arrived on November 27th, and on November 28th, I began the process.
Thank you. Thank you. One of the things I also noticed about was you're going through a rulemaking process that would allow banks to provide short-term, small dollar loans. I guess payday loans, is that what we're talking about? Or?
No, we're not going through a rulemaking. We issued a bulletin. There are two segments. There's the 0 to 45 days, which is normally defined as a payday loan, where there's one source of repayment. We issued a bulletin to encourage banks to get into the market that's 46 days or longer.
Okay, I appreciate that clarification.
Yeah, which generally is paid from multiple paychecks over a period of time. And banks had exited that business in 2013, and we've encouraged them to go back into that space.
Would that also include overdraft lending or?
It would not.
Okay. With regard to the Bank Secrecy Act and anti-money laundering legislation, one of the ways in which you have phrased the current BSA-AML examination as a gotcha system, in which an institution's compliance regime can be deemed deficient based on a single or isolated incident. What steps is the OCC going to take to ensure that the BSA compliance is geared primarily towards deterring illicit activities and not just assessing fines?
Well, first of all, I don't know if you were here when I made the comment.
I was not.
Yeah, that the OCC led an interagency which included the Fed and the FDIC. Our staffs and the principals from that got together, and we came up with 14 items that we thought we could improve the current system that banks are using. We submitted that to FinCEN at the beginning of May.
Right.
Last Friday, they came back to us with some edits. We plan to use that as our control document and create a group of people that will work on BSA, and similar to some things that we can do, some things we'll need some.
It's more proactive?
That's right. Right. And I would say, you know, our viewpoint is we have a very cumbersome, paper-oriented, producing lots of documents that I'm not sure gets to the core of stopping people from using our banking system inappropriately.
Under the current BSA framework, do you believe that financial institutions are required to collect information on their customers that are of no use to law enforcement?
They're required to comply with the currency transaction reports, and when they identify suspicious activity, they're required to complete SARS.
Right, but otherwise collecting information other than for that purpose would be inappropriate under the Bank Secrecy Act.
You'd have to give me a specific example, but as a general rule, I would agree with you.
Okay. Is the OCC currently working to improve the type and amount of information required to be collected and how that information is communicated to law enforcement or regulators?
I think through the initiative with the BSA, I think we can get there. One of the key things I think is this is an important element of stopping bad people, is that we make that information available. I think it's really critical important for us to be able to have dialogue with what is important to law enforcement to be able to stop illegal activity.
And what protects the privacy of the
That's correct.
Of the customer. Thank you. That's all I have. I yield back the balance.
Gentleman yields back. Chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you, Mr. Chairman. Mr. Otting, let's go back. I want to talk to you about the possibility of the FinTech special order. Are you going to offer it or are you not?
We have not concluded a decision at this point.
You are aware that when your predecessor offered that the state banking, the Conference of State Banking Supervisors filed suit against you, against the OCC. What is the disposition of that?
My disposition is that the National Banking Act gives us the authority to issue that charter.
And so legally, where is that suit? Has it been dismissed? Or?
No, the judges in those cases found that it was not cause at this particular point in time on those lawsuits because we had not actually entertained any applications.
Well, for the very nature of that suit, and when you look at it from the standpoint of the fintechs themselves, unless we can find a way to satisfy some of the concerns that the state banking regulators, who certainly have first call on this, because these fintechs don't call just one state home. They operate across the nation in 50 states. So there is a role for the state banking supervisors. If that is not resolved, then we're putting the fintech companies in a very untenable position. Now, that's one point. The other point is that you came by my office, and thank you for that. We had a wonderful visit. And at that office, I shared with you legislation that my staff is working on in conjunction with both the Democratic staff on this committee and the Republican staff to come up with a bipartisan piece of legislation that clearly needs to be put forward first. These fintechs are faced with a plethora of regulators. You got yourself, and you got this problem with the state supervisors. You also got, like the FDIC. Some fintechs may even go for that charter for industrial loan companies. And if they do that, they fall under a very serious benefit of being able to compete in a way that puts the smaller banks at a disadvantage because they won't have to jump through the same hoops to get that Federal Reserve insurance for their deposits. You got that, and then you got the CFPB with Project Catalyst, and they've offered only one letter of action, no action over all their period. And then you got the CFTC with LAB. My whole point is that it is my hope that you've had a chance to, as we said, you were going to chat with my staff and get the idea of the legislation that we're proposing. It is so important that as we move to find out how we're going to regulate this burgeoning industry, that we don't move so haphazardly that we suffocate the innovation of this industry. And so, as I pointed out, did you get a chance to contact my staff and get a look at it?
Our Office of Innovation staff met with your staff as a follow-up to that meeting.
So they've got that. So what do you think? And just as a prelude, the legislation would require something first before we really get into this, which we know all these different agencies are biting at the bit to regulate this industry. So our legislation will be to set up and require that these regulatory agencies harmonize and coordinate. Make that a requirement going front, because you got so many wanting to get into them. If not, we're going to be very destructive to this burgeoning industry. So, and I asked you, I said, I hope that you will be with us on this. So you agree with us, right, for that that's what we want to do?
I don't disagree with you, you could coordinate, but it really depends upon where the fintech decides they want to be domiciled and what regulatory agency. I mean, if they're going to operate in a particular state, then most will choose to be regulated by that state banking group or multi-state.
And that's why another part of the bill will be to give the fintechs a point of entry. So I'm just saying we got to look at it from the standpoint of how do we effectively regulate this new burgeoning industry.
Time of the gentleman has expired.
I'd be happy to come by and have further dialogue with you.
All right.
Time of the gentleman has expired. Chair now recognizes the gentleman from Illinois, Mr. Holgren.
Thank you, Chairman. Thank you, Comptroller Otting. Appreciate you being here. As you noted in your written testimony, S2155 includes a provision requiring the federal banking regulators to permit for a short-form call report every other quarter for institutions with less than $5 billion in assets. Obviously, Congress would have called for this change if we were would not have called for this change if we were satisfied with the relief from the call report being considered via the GRIPA process. I sponsored the standalone bill in the House with Terry Sewell and also Andy Barr, and so I'm very interested in your plans on implementation of this legislation. What's a reasonable timeline for banking regulators to propose and finalize regulations, and wondered if you've thought at all about what a short-form call report might include?
First of all, earlier in my comments, I said we've organized a group of people within the agency, a task force, to focus on the entire bill. We've narrowed things into what can we do short-term very quick, what are medium-term that we have to write a rule, and then what will require interagency. This is an area that we think we can implement very quickly.
Great.
And I can tell you that you'll have our resources to move fast on this particular issue. I can't give you an exact timeline, but I'd be happy to follow up as we get further along the path.
Thanks. That would be great. I also would ask or would recommend you and those who are specifically tasked with that to take a close look at what the Independent Community Bankers of America has proposed as a reasonable short-form call report. This includes Schedule RI income statement, Scheduled RIA, changes in bank equity capital, and Schedule RC balance sheet. If I can move a little bit, I wanted to ask briefly and see if I could ask you to discuss with you the treatment of centrally cleared options as it relates to our risk and leverage-based capital rules. The Treasury Department's October 2017 report on capital markets notes, and I quote, "The CEM may be responsible for a corresponding reduction in banks' ability and willingness to facilitate access for their market maker clients, who are the primary liquidity providers in these markets," end quote. I understand this concern was realized by some market makers during some of the volatility incurred by the markets earlier this year. I've talked with dozens of market participants and many of my friends on the other side of the aisle, and there seems to be strong agreement that our capital rules should be tweaked in order to improve liquidity in listed options markets. Our challenge has been getting the undivided attention of the banking regulators to address this. Wondered, would you commit to work with your colleagues at the Fed and FDIC to address this issue?
Yes, I would.
Great, thank you. I also want to thank you for your work to reconsider aspects of Section 619 of the Dodd-Frank Act, the so-called Volcker Rule. One specific topic I'd like to raise with you is the Volcker Rule's detrimental impact to venture capital funds and the startup companies that they support. Before the Volcker Rule, banks provided 7% of dollars invested in venture capital funds and were a reliable source of funding for smaller venture capital funds as they're not as attractive to larger institutional investors. I wonder, do you believe that venture capital funds should fall within the definition of private equity funds first? And has the OCC studied how a change to the covered funds prohibition that exempts venture capital would permit for more investment in startup companies and overall economic growth?
I do believe it does fall in under the current definition. I personally have sat on 2 boards of financial institutions that did those type of equity investments. I did view it as a legitimate, stable source of proceeds to funds that invested in small companies across America. And we did put out in the notice of proposed rulemaking, at least for people to comment on the definition.
Great. Yeah, I would agree that this really is the backbone, and we want to continue to encourage small companies to grow, but also to go public. It's something that we talk about all the time here of really the harm that's done to mom and pop investors by not having more of these smaller companies grow to become public and choose to become public. So also, I'm sure as you're probably aware, this change that I've talked about is recommended by the Treasury Department's October 2017 report on capital markets. And again, thank you. I would just continue to ask that you and your colleagues at the other financial regulators prioritize this when considering changes to the Volcker Rule. Last question in the last few seconds. The OCC has begun consideration of a special purpose charter for fintech companies. This was a priority of Comptroller Curry. However, this process seems to have stalled over the last year. Where's the OCC on the process, and how do you envision a fintech charter working? Do you believe your views differ from Comptroller Curry on this?
Once I arrived in November 27th, I have spent a significant amount of time internally with a number of the agency's people. We've done a lot of work. We've publicly said that in July we will make a decision whether we will formally allow applications to come in for a fintech charter, which we call a special purpose charter. It's our expectation that that will require capital liquidity and serving the community like any bank across America.
Thanks again. Appreciate your time. My time has expired. I yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Missouri, Mr. Cleaver, ranking member on the Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. Comptroller Otting, here in Congress, we can choose pretty much what we're going to be, and I've chosen to be respectful. I have to say your earlier response to Mr. Capuano was stupefying, even jaw-dropping, as it relates to discrimination. And if you believe polling data, the Washington Post Harvard study shows, first of all, that the level of racial animus is at the highest level today that's been since 1997, and it's a little disconcerting to me because the United States has never eliminated any of its problems by denying that it existed. You did not deny that it existed. You said you just had never seen it. I was wondering if you were aware of what happened recently in Charlottesville.
I only observed that from what I was able to see in the news.
So you wouldn't be in a position to know whether or not there were people who were wrong or right, or the supremacist who spoke and who acted. You based on what you saw on TV, I guess, and read, you don't attribute one side as having way more than discriminatory feelings. I mean, what did you witness?
To be honest with you, I don't watch TV. If it's not often on ESPN or on CNBC, I'm not a TV watcher. I saw what was across the headlines, but I didn't spend specific time to study or analyze what took place.
So you didn't read any of the articles in the newspaper?
I don't read a newspaper.
This is very difficult for me. One of the questions I wanted to ask was about the charter and whether or not you believe that there needed to be something in the charter about minority inclusion, but there would be no reason for minority inclusion if there is no exclusion. So I'm assuming that that's not going to be anything you would address since you are not aware that it even exists on the planet.
No, I would say I'm a big believer in minority inclusion. I think my track record through my banking industry, there are many people who would say that Joseph Otting spent more time in the inner cities of America than most banking executives across the world.
Yeah, well, that's doesn't. Yeah.
But on a particular example like you're describing, I don't have a personal opinion on that.
You don't have a personal opinion whether there's been any discrimination in banking?
Again, I have not personally observed that.
Mr. Chairman, I yield back. I can't go any further.
Gentleman yields back. Chair now recognizes the gentleman from California, Mr. Royce, Chairman of the Foreign Affairs Committee.
Thank you, Mr. Chairman. On May 23rd, you issued a bulletin encouraging banks to make responsible short-term installment loans. Are you tracking whether banks have re-entered the market since the bulletin came out?
Congressman Royce, we communicated with banks shortly after my arrival that this was one of my priorities. Most banks had shelved any products that they had after 2013. I have personally met with all of the large bank CEOs and asked them to take a look at being involved in this. And I think it'll take a period of time. Most of the regional banks, I think, are reacting quicker because they had products that they thought they could bring to market. It'll take a longer period of time for banks to work through their products and then go through their risk process before they offer those products into the market.
Maybe we could look at what metrics there are to date, or maybe in a week or two, and you could get back to me with some
I'd
more
be happy to.
specifics.
I mean, I think it's going to take a period of time.
I understand your argument there. I see your point. One area where there's been some confusion based on the recent bulletin are bank fintech partnerships, such as marketplace lending programs. Some have construed a provision clearly targeted, it looks to me like it's targeted to rent-a-bank schemes, but they view that as undermining bona fide partnerships between banks and fintech lenders. And some have wondered about a clarification on this. I think there was some in the press that this is not the intention of the small dollar guidance, but I was hoping we could hear you out today on the OCC's views on these arrangements.
We're supportive of these arrangements with fintechs where they are bringing technology to financial institutions that can do outreach to communities, customers, prospects. And so we are supportive of that. We would expect them to go through their normal vendor management programs to assess the risk associated with those entities, but we are supportive.
Okay. When looking at reform of the Community Reinvestment Act, you said that you're a big believer that we should stretch it to more small business, more community development. The local bankers who I met with last week in Southern California are frustrated that more small business lending is not included. The classification of some loans doesn't get a complete picture of the impact banks are having in their communities, including, of course, in job creation. So could small business loans with a community development purpose be classified as a community development loan? Would that be an option where you have that, or as a loan under the general test? Or maybe go into some of the remarks you made this morning when you talked about we need to develop a metrics-driven approach to evaluating performance. Would adding these in a way into the standard metrics that you're trying to develop, would that be a way for these small banks and others to sort of meet that test?
Congressman Royce, I think the measurement element is different than the qualification element.
Okay.
And it's my belief we should broaden the category that includes.
Broaden the category.
Activity. Right.
All right. And I will yield back then. I appreciate
You're welcome.
that information.
Gentleman yields back. Chair now recognizes the gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman, and thank you, Mr. Otting, for being with us today and for your testimony and expert witness. I would like to ask you what could be done today by regulators to encourage banks to offer short-term credit to our constituents?
I'm sorry, I missed your.
What could be done through the regulators, by the regulators, to help encourage banks to offer more short-term credit to our constituents?
I think the guidance that we've been discussing, I think goes a long way in that. I think the next big chunk of that is to look at the 45-day and under that is currently controlled by the rule that's going to go into place in the BFP. And we would like to work towards, can we come up with a solution in that space that would allow banks to get back in there and do that in a fair and, I think, economic way for consumers.
Could you speak, in addition, some more to what could be done to help increase greater transparency and investments in our communities that need it the most?
You're talking about low to moderate income
Yes.
communities.
Mm-hmm.
What could be done more?
In terms of just increasing transparency in this and the investments in these communities?
Well, two things that I think are important is that to identify more categories that can qualify by broadening the products that would qualify as CRA qualified. Mm-hmm. And those, as I said earlier, I think there are parts of churches that, that should qualify for CRA. I think, in a lot of communities, people go to their church to get financial counseling.
I agree.
I think also our assessment areas, the way that they're often defined, restrict a bank to a particular area. And I've seen examples where on one side of the street it qualifies as CRA, and the next side of the street it doesn't qualify for a bank. So I think taking a hard look at how we narrowly define the assessment areas could broaden banks' perspective of where they can do their investment and lending activities.
I appreciate your clarification on that. In your testimony, you said, quote, bank regulators, law enforcement, national security personnel, and bankers must continually adapt to increasingly sophisticated criminals and other illicit actors who take advantage of the nation's banks and financial system, end of quote. If developments and advancements are critical to success, then why has the current BSA regime failed to undergo any significant changes since the 1970s?
Why has it not?
Yes, sir.
I think it has. It's been, we've added to the process. And I think with current technologies today, there's ways that we can, I think, take databases and scan those databases and use artificial intelligence to be able to go through them. They're better than individuals looking at a currency transaction report and then filling out a SARS. If you think about it, if you have one bank in a vertical and you're providing that SARS, but that bad person goes, bank to bank to bank, we don't tie that all together. And I think with technology, we can start to tie that together, and it's not a paper flow.
In terms of compliance cost and related privacy issues that are of concern to many, would you think that the system would be better served if the government provided access to those accounts, that data that they're most concerned about, to banks, financial institutions, in lieu of the tremendous amount of SAR reporting that is required?
It's probably halfway. That would be, I think, a valuable thing if we knew what entities or individuals that are under the microscope that we could help. But I do think that then you get into some issues that I think along the lines of, there's been some legislative proposed that hold the bank, harmless in the event that they continue those relationships with those accounts, that they're not, unduly, criticized.
Sure, they need a safe harbor.
Yes, as long as they're holding those accounts open, so for the benefit of law enforcement.
Yes, sir. It seems to me that the process would be better served if the banks were responding to the concerns of law enforcement than just providing innumerable numbers, millions, to the effect of SARS reports, and for responding instead to what they're looking for. We would have it seems to me, a much better grasp of the privacy and security and civil liberty concerns by the public.
Yeah.
Do you have a comment on that?
Well, today, we produce all this information. As I said earlier, there's about 10 million documents, 9 million CTRs, and 1 million SARs that are produced. Generally, when there's a hit by law enforcement, they do go seek that additional information out from the bank today. So there is, banks generally are contacted when there's some event associated with an individual. But I think to your point is 97 or 98% of the information that we produce, very rarely do the banks hear back from law enforcement on the data that they're providing.
Thank you. My time's expired.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Comptroller Occ, when the House considered S-2155, I expressed concerns around many aspects of the legislation, particularly the increase in the SIFI threshold from $50 billion to $250 billion. One of my concerns is that this new threshold continues to fail to take into account the actual risk posed by the largest institutions. Some over this new line continue to pose little risk to the system, while some below could pose substantial risk. This has been shown time and again by the Office of Financial Research under both President Obama and President Trump. How do you propose to tailor regulations to a firm's actual systemic risk on both sides of the new $250 billion threshold in order to continue to protect our nations against systemic risk?
I am actually supportive of those new guidelines that were issued. I do think banks' risk management is the best it's ever been in the 35 years. It doesn't mean just because that guideline has been lifted that banks will not continue to perform some of those functions, and we will review those in our annual examinations of those financial institutions.
So I expect that you regulate banks on both sides of the 250 billion with equal weight and scrutiny. Those that are above 250 and those that are below. That would include most of the banks.
We used a risk-based system is the way that we do our annual examinations, and so we look at all of those institutions and understand where we think there is risk, and based upon that, that is the resources we provide to those institutions. So to your point, if we observed significant risks being imminent or deployed in an institution, we would allocate resources to that institution appropriately.
Okay. I understand that leverage lending often serves as an important financing tool for many businesses across the country. However, I also believe that banks shouldn't be left without a regulatory roadmap to guide how such transactions can be made without compromising the safety and soundness of our financial system. Earlier this year, you commented that, and I quote, institutions should have the right to do the leverage lending they want as long as it doesn't impair their safety and soundness. Can you elaborate on that statement and talk about what steps, if any, the OCC and other federal banking regulators are taking to revise the 2013 interagency guidance on leverage lending, particularly in light of the GAO's determination that the guidance was a rule for the purposes of the Congressional Review Act?
First of all, thank you for allowing me to clarify my comments. You know, what was left out of that quote was the lead up to it, where I said that banks would have to have the appropriate level of capital. They would have to have the people to properly analyze that risk. They would have to have a risk statement that was approved both by management and the board. And those were left off before they put the punchline in there, so to speak. So
was that CNN that reported that?
No, it was not.
Oh, okay. Oh, so then you watch CNN.
I don't watch CNN.
So how do you answer? Okay.
I know the particular,
All right.
I know the particular news agency that produced that. So in your second quarter regarding the OCC's guidance on leverage lending, I'm sorry I missed the point you wanted me to address on that.
Well, the GAO determination, and particularly in light of the GAO's determination that the guidance was a rule for the purposes of the Congressional Review Act.
Yeah, we have gone out of our way since that ruling to educate and make sure that our examiners understand the difference between rules and guidance. Mm-hmm. And we've issued documents within the OCC that clearly spell that out. And as part of that comment that you were quoting me on, I made that comment as well.
So are you going to appeal the guidance?
No. We had put that guidance out for comment. Maybe you're saying, are we going to reproduce that guidance for comment? And at this point, we are not.
I yield back.
Time of the gentlelady has expired. Chair now recognizes the gentleman from Pennsylvania, Mr. Rothfuss.
Thank you, Mr. Chairman. Welcome, Comptroller. I want to thank you for your continued help and support for our Federal Savings Association Charter flexibility legislation. As you mentioned in your testimony, the reform that Congressman Himes and I have championed will provide Federal Savings Association with the flexibility to operate with the same rights and duties as a national bank without having to go through a costly and time-consuming rechartering process. This was recently signed into law as part of the bipartisan financial regulatory reform package. Why is this specific provision so important?
That provision, from my perspective, you may know that when I went to One West Bank, we were a thrift, and as part of my mission was to diversify the balance sheet for the institution, and so we grew our commercial loans and commercial real estate. and we quickly hit the cap at that point in time, and so we felt we were servicing the community. And so our ability, like those particular entities, are looking to service their communities in a diversified manner, and often they hit those caps in a relatively, quick period of time.
So looking at the impact of this reform,
Yes.
what do you see happening in a community that has a thrift?
I think they will broaden their support of the communities to which they operate.
Could you provide an update on the timeline for implementation?
Earlier I said we've created a bucket of things we think we can do quickly, things that we need to write rules on, and the third being where we have to have interagency. That falls into the first bucket that we think we can move very quickly on that.
Great, thank you. In your testimony, you discussed a number of possible avenues for reforming our outdated BSA/AML regime. Our committee has held several hearings on this issue, and I've had the opportunity to meet with a wide range of financial institutions and practitioners. It is clear that this system needs to be modernized to account for the ever-evolving nature of the threat. New technologies like artificial intelligence show considerable promise in helping financial institutions and regulators better combat illicit finance. I am proud that Western Pennsylvania institutions like Carnegie Mellon University are leading the way in this field. Could you explain how new technologies like artificial intelligence can help improve our approach to disrupting illicit finance?
Sure. I think the way new technologies are going to work is that we're going to be able to go through interbank connectivity between bad person activity. Today, if you think about our CTR and our SARS process, it's generally a vertical within one institution. And when somebody, the bad guys are smart, they know the rules, they move money in, they move it amongst the organizations, and then they flush it out the door. If we can track that interconnection with those proceeds, I think technology will play a big important role there.
Do you think there's anything that regulators or law enforcement can do to facilitate the continued development and adoption of these new technologies?
I think there's been a lot of discussion about whether that should be a government or a private enterprise venture. And I think what you're seeing now is movement towards that being a private enterprise, and I think that will accelerate the activity.
I understand the OCC is continuing to study ongoing developments in the fintech space. What are some of the key principles that guide the OCC's approach to ensuring that we facilitate pro-consumer innovation while protecting the safety and soundness of the financial system?
It is that our expectation that a fintech would have similar capital liquidity and requirements to serve their community as a regular national bank.
How can we guard against regulatory arbitrage?
The way that I think we would guard against that is that those that want to serve multiple markets either have a choice, A, being that they go and they find states that will synchronize their regulation process, or that people will have to use the national bank.
In your testimony, you discussed the need to re-examine assessment areas for the purposes of bank compliance with the CRA. As you know, the current approach is largely based on an institution's retail branch footprint. Mobile banking products are becoming increasingly popular. How should this development impact the way we evaluate future CRA compliance?
Yeah, I would argue in some regards the assessment areas have restricted banks' ability. And as an example, when I ran One West Bank, we were in LA County. LA County was our assessment area, but we had branches in Inland Empire, Riverside, and Orange County. But those particular areas were not part of our assessment area, but we wanted to make investments in those areas, and we had to satisfy our Los Angeles needs first. So I think looking at more broadly, where are your customers, which would include, mobile banking, and asking institutions to support those communities where their customers are or their employees, I think will be important going forward.
I was intrigued with your conversation with Congressman Wagner about any kind of interplay or integration with faith-based organizations and CRA. Can you go over that a little bit?
Could you ask that question again?
Whether faith-based organizations, how they can be integrated or helpful.
I have lots of experience with faith-based organizations across the nation, and most of those, my observation is in the Black and Latino communities. Most of the families go to those church organizations for their financial counseling, job development.
My time's expired. I may want to follow up with you offline on that.
I would be happy to do that.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Colorado, Mr. Tipton.
Thank you, Mr. Chairman. Comptroller Auditing, pleasure to be able to see you here, and thanks for appearing before the committee. One thing that you and I have had the opportunity to be able to visit about was, and I know you do understand this well, is The time from your time in the private sector is the need for certainty in terms of regulation and supervisory expectations for the banks that are under your supervision. And if you would, I'd like you to be able to take maybe a moment to speak about some of the controls that are in place to prevent that uncertainty from entering the examinations process in the event of a negative economic impact, and what steps your agency takes to prevent the potential of supervisory retaliation.
Yes, we have very well-defined controls. We have, obviously an examination process that takes place. Generally, outside that direct examination is we have resident experts that also review the data associated with any examination. Then we have a deputy company controller that's generally involved in that. At any point in time that a bank would feel that they are not being treated fairly or the regulations are not being applied properly, they have a formal appeal process. And if they're unsatisfied with that formal appeal process, they can come through the ombudsman process, and that person reports directly to me, and I meet with them on a weekly basis, and we cover any of the items that have been brought up.
Okay, thank you for that. I did want to express one banker from my home state of Colorado observed that the regulatory environment of the past, specifically between the OCC and what we call the Consumer Protection Bureau, now the BCFP, presented the risk of double jeopardy and has concerns that the regulatory agencies didn't coordinate with each other in terms of examinations. Would you describe briefly how your conversations with the Federal Financial Institutions Examination Council inform you in the examiner's decision-making and how they determine that supervisory action is needed?
First of all, I do meet with the FDIC and the Fed on a weekly basis, and we talk about all kinds of issues like this. And then I also meet with Acting Director Mulvaney, and where we've had actions that it's been generally at the principal level, where we'll, with staff and principal, to resolve issues like that. So, and I would encourage you, if any CEOs of banks that you're familiar with or interact with that have that issue, that they can call me directly, and I would be happy to have dialogue and discussion with them on that.
Great. And so you are comfortable that the agency's ombudsman that handles the appeals process for the supervisory decisions regularly communicates and coordinates with the other regulators on the appeals to prevent double jeopardy?
Yeah, I did check. I knew you were going to ask me that question, and that there is a formalized structure where they meet frequently to have dialogue about any particular issues as well. Okay. And as I indicated, I meet with Larry Haddix, every week, and we talk about any items like this.
Okay, and when we're talking a little bit about the in-house dialogue that's going on, and I know that you can appreciate this from the private sector end of it. From a business standpoint, when you were in the private sector, would you have found it agreeable to be able to appeal a material supervisory determination that you felt was unfairly or erroneously determined back to the same agency that handed down the determination in the first place?
I think it depends upon the leadership in the agency, but I would definitely feel comfortable in today's environment for a CEO to want to do that. And like I said, he would have the option to call me directly if he felt impaired by that process.
Okay. I guess just to follow up on that, I have a piece of legislation called the Exam Fairness Act that I think you're probably aware of, to be able to have some independent examination for an appeal process. Is there a conflict? And again, I'd just kind of like to emphasize that point from when you were in the private sector to appeal back. You may not always be in this position.
Yes, I found when I was regulated by the OCC, I was totally comfortable with that process and always received, I think, satisfactory results when I appealed a decision of the EIC up into the agency. I never at any time had to go to the ombudsman because I felt that generally it was fair and complete, and oftentimes it was my misunderstanding of the rules or the regulations.
Okay. Thank you. I appreciate your comments. Mr. Chairman, I yield back.
Gentleman from Colorado yields back. Gentleman from Maine is recognized.
Thank you, Mr. Chairman, very much. Thank you, Mr. Otting, very much for being here. I appreciate it. I congratulate you on your new position. I'm sure it's stressful, and I want to remind you that Maine is vacation land. and this is a great place to go and have a summer vacation. I'm sure your family would appreciate going up there and enjoying 3,000 miles of coastline and blueberry pie and lobster and moose and everything else. So when you want to go up there, make sure you give us a call. We'll set you up.
Okay, thank you.
You're very welcome. Sir, I represent the rural part of Maine. Now, some people think that that's unusual, but there are parts of Maine that are not rural, not much, but there are parts. In the 2nd Congressional District, we have about 400 small towns. We're a district of small businesses, small savers for the most part. And what I'm concerned about is identity theft and other types of cybersecurity. You know, when you have folks in Maine living their lives and they have a credit card and a checking account, a savings account, maybe an IRA, and they're buying some property and casualty insurance, and it seems like every place they go, Mr. Auding, they're giving out their personal information. And this is a real issue for the families that I represent if something happens and there's a breach. Now, I know that there are financial institutions throughout that sector of our economy that are regulated by different agencies. And sometimes you have the same financial institution that's regulated by multiple agencies, like you folks at the Comptroller of the Currency or the CFPB or maybe the Federal Reserve. It's expensive, it's time-consuming for these smaller financial institutions to do that work, and at the same time, making sure they're fighting those that are trying to rip off their personal information. So do you folks coordinate with other regulators that are focusing on the same institution such that we can become very efficient and coordinated and not chew up time and resources needed to catch bad actors?
I would say probably not as good as we should.
Why not?
Would be the right answer. I would say I think at the federal level, we do a much better level of coordination in conjunction with Treasury. There's a lot of activity. You know, obviously, you know that when we go out and we do our examination on an annual basis, we look at the security, you know, part of the normal exam is look at the security parameters, look at the hardware, look at the software, make sure patches are up to speed. And then we also do assessment of the recovery. But if somebody, often, you know, as you know, somebody might have a product with us and have a product with a state bank. And the question that you have there often is coordinating when entities are not interconnected.
How do you fix that?
You know, I've heard the mention of national standards, and that's probably the way I think you ultimately get to that, is some kind of national standard.
Mm-hmm. Has this been attempted in the past, Mr. Auding?
Not that I'm aware of.
And have you received these sort of inquiries in the past?
I wouldn't say I've received inquiries in the past. I would say that the Treasury Department is trying to coordinate amongst the federal national examiners an approach that we're making sure that there's interconnectivity amongst the national agencies.
And is this an ongoing sort of loose, informal discussion, or do you actually have an agenda item that you're working on to make sure this is addressed?
I do not have an agenda item.
What would it take to get one?
Probably knock out CRA, BSA. I've knocked out small ticket lending, and I would be happy, you know, once we get the capital and the Dodd-Frank issue done, to put it in the queue.
I appreciate very much that forthrightness and also the interest in working with us on that. Thank you very much on that, Mr. Auding. You mentioned earlier today on a different topic that you're considering a new charter for fintech, and you mentioned that that decision will be made in July. Are you comfortable and confident that all the stakeholders have had the time they need to weigh in on this issue?
I think there's been a lot of dialogue and discussion on this particular topic. Am I comfortable at all? I don't know if I could define the word all correctly, but I think a lot is the way I would describe that.
Comfortable enough to make a decision?
Yes, I would be comfortable enough to, and we haven't made the decision yet, because this is somewhat unique that if you think about it, if they don't have deposits, then we would be the resolution of a failure of one of those institutions. So we've had to look at the whole linear approach to that process. But we've also said that we expect capital, liquidity, and serving the community to be part of any charter.
Thank you very much, Mr. I appreciate very much you being here, sir. Yield back my time. Thank you.
Gentleman from Maine yields back. The gentleman from Minnesota, Mr. Emmer, is recognized for 5 minutes.
Thank you, Mr. Chair. Thank you, Mr. Auding, for being here. Don't know if we crossed paths while you were in Minnesota, but I think you were on your way out a few years ago, what, 2010 maybe?
Yes, that's correct.
Well, you're welcome back anytime. Mr. Pollock, when waxes poetic about this mystery land up in the northwest, east part of our country, but Minnesota.
The northern fishing up there, so.
Yeah, you bet. I want to ask you a couple of questions in a couple of different areas. One, first, because of your background in banking and the financial services industry, is it safe to assume that you're familiar with the concept of de-risking?
Yes.
To what extent does the complexity or uncertainty surrounding our current Bank Secrecy Act, anti-money laundering regulatory regime contribute to the practice of de-risking?
I'm not sure that that regime necessarily contributes to it. I think what it does is it helps identify entities that are conducting those kind of activities.
And then, from your experience, where does it go from there?
And then generally the financial institution will evaluate the risk and the controls of a particular entity in a segment of the industry. And I think where we've had some problems is the amount of controls that they need. Perhaps the company won't provide those, or they can find another alternative that doesn't require those controls, or the cost in the institution to provide oversight is greater than what the revenue is being generated off of the account.
I'm interested in the second one that you mentioned, which is they find an alternative.
That's right.
That doesn't require those controls. Because in fact, when you start doing this de-risking, the people that we're trying to discover are going to find other ways to deal with the cash they're trying to move. That's your experience?
And sometimes, I would say more frequently, they work it out with their existing financial institution. Okay. But there are exceptions where they will leave that financial institution and seek alternatives.
How can we coordinate or improve the coordination between FinCEN, who's writing the BSA regulations, and the examiners like OCC, like yours, to streamline the regulatory landscape of our current BSA AML structure to ultimately address issues like de-risking and improve the transparency of certain financial transactions?
It's my number 2 priority behind CRA, and I will tell you I have dedicated an enormous amount of time in the last 5.5 months to get BSA. I think we're at the table now with the right issues identified, and I think with the working group we're creating with FinCEN, the FDIC, the Fed, and the National Credit Union Association, I think that we will move that dial over the next 3 to 6 months.
Fantastic. Lastly, although I might have something that leads from this, in your opening remarks today, you mentioned exploring the expanded use of technology as a means to lessen the reporting burden and improve the efficiency of our BSA AML efforts. How do you see technological innovations like blockchain and you've talked about artificial intelligence a little bit in your testimony today? Yeah. And people have asked the question, but nobody's gone directly at it. Blockchain technology has appears to have major promise in terms of the transparency and the ability to track where things are going. And I'm just wondering, how do you see a technological innovation like blockchain technology impacting this space?
I agree with you. It does have promise. The question will be how we use it in applications going forward.
Well, but this is I guess what I'm going to ask, there's an issue here in Congress. Not enough people with election certificates understand what this is. They seem to be focused totally on cryptocurrencies every time they talk about this technology, and that is an issue. But blockchain is a lot more than cryptocurrencies, which is why folks in your position, the more that you're learning about it, the more that you're looking at the potential applications. Have you done any of that yet, or is this part of the group that you're getting together?
It is not part of that initiative. We focused on 14 items that we thought could improve the efficiency of financial institutions complying with BSA and AML. We have not focused on blockchain. I, like most people, are learning more about this as it kind of evolves. I had not even heard the word blockchain 6 months ago, and now it's almost,
Now it's the rage.
That's right.
I guess going forward, would love to be in touch with you about the group that you've put together for the BSA AML effort, and then also as you get up to speed on blockchain, how it might apply. Okay. Thank you very much. I yield back.
Gentleman from Minnesota's time has expired. The gentleman from Georgia, Mr. Loudermilk, is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Otting, for being here. As you and I have discussed before, one of my key issues is cybersecurity and the protection of data. And I appreciate my colleague from way up north bringing up the blockchain. As we have discussed, I think it's imperative that we decouple the conversation of blockchain from cryptocurrency, and is something that we need to investigate as a method of secure communications and data transactions. But what I'd like to focus on as far as cybersecurity goes, can you briefly kind of explain what are you doing in the OCC and private sector to ensure that the data that, quite frankly, the government forces businesses and individuals to pass along and maintain, what are we doing to ensure the safety and security of that data?
On an annualized basis, as part of our annual examination of financial institutions, and generally these are the larger because, you know, we have some exemption for the smaller institutions, we actually, as part of that, do an examination of their data security and their technology. And there's a formulatic approach to that examination. I would be happy to have some of our people come over and walk you through that so you understand it. But I mean, for the most part, we're checking security perimeters, we're checking hardware, we're checking their software, their patchwork. All of that activity goes into that final analysis. And then, you know, if there's obviously actions that need to take place, mostly they would result in an MRA where we would request certain actions associated with that institution.
Okay. And I appreciate that. One of the issues that I think hurts us, ultimately hurts the American people, is we have a multiplicity of regulations regarding cybersecurity. There doesn't seem to be a consistency. Are we doing anything to actually coordinate with other banking agencies to ensure that we're operating from the same rule book, basically?
Yeah. The Department of Treasury is coordinating amongst the agencies. We, in fact, Friday, I have a meeting on this in the Friday of the afternoon. They have taken on a role to kind of coordinate and lead amongst the agencies. We have been studying, analyzing, providing data, and trying to get some more consistency to the process within the agencies today. So I would say I've been here 5 or 6 months. I don't know if that was going on before I arrived, but I would tell you it's like full steam ahead at this point.
Well, I appreciate that. And one thing to keep in mind as we move forward, and I'd like to continue our engagement that we've already had with this issue, is one of the areas of weakness I see is how many points of data we have within the federal government. When you look at the PII of individuals, do we have that same information in various different agencies, which means the more instances you have of the same data, the more likelihood that it's going to be released. Is there something that we can do to centralize that to give, you know, common access to that? If I could shift gears real quick in the time we have remaining and talk about the Bank Secrecy Act for a moment. I know I've been advocating that since the 1970s is when we set the $10,000 limit for the currency transaction report, and if we were to span that out over the course of time with the rate of inflation, it should be at about $60,000 today, which is something I've been advocating for. But we do have legislation that brings it to that from $10,000 to $30,000. Can you briefly explain why it's so important we modernize the BSA by increasing these thresholds?
Well, you know, the issue is we file 9 million currency transactions reports on an annual basis out of the U.S. banking system. Often what we're finding is, you know, real legitimate businesses that banks have been done business with for a long period of time are tripping the structuring. And that structuring then causes us to produce paper that I think in the end really is unwarranted.
More paperwork, red tape as the people know it, and little of it actually leads to actually accomplishing the goal at hand. So are you comfortable, with the 30 seconds I have, do you think the threshold of 30,000 will provide an adequate relief of the overburdensome paperwork?
I think it's a great step in the right direction.
We could go a little further?
I think that's a fair place to start.
Okay. All right, thank you, and I yield back the remainder of my time, Mr. Chairman.
Gentleman from Georgia yields back the balance of his time. The gentleman from Tennessee, Mr. Kustoff, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Comptroller Otting, for being here this morning and this afternoon.
If I could, I'd like to follow up with some questions asked by Congressman Emmer as it relates to the BSA AML reform. I agree with your testimony where you said that we need to reform the BSA AML to be more efficient while improving the ability of the federal banking system and law enforcement to safeguard the nation's financial system from criminals. If you could you discuss some of the most burdensome components that banks face under the current BSA AML structure?
Yeah, I think it's, there's three, I would say, core things. It's the number of CTRs that need to be filed, which is around 9 million. It's the SARS, or currency transaction, around 9 million. The SARS, which is about 1 million. And then today, the way we do examination, we do not have a risk-based examination process. It's a one-size-fit-all, and you may have missed it, but I said, look, if you have a management team that's highly rated with a very strong compliance department, a very strong BSA, and a low-risk customer base, we examine that entity the same as we have a weak management, a weak compliance, a weak BSA, and a high risk. And we need to bring balance, because when these entities are showing we have good, solid programs in place, to put them through all of those same activities, in my mind, is duplicative.
As it relates to the SARS, do you have a recommendation, if you could wave a magic wand, what that level would be?
Well, on the currency transaction report or the SARS?
Let's talk about the SARS first.
Okay, so I think the question that we have with SARS is there's 1 million SARS being filed a year, and I think a lot of the SARS, we've gotten banks to the point where they're so nervous that they file a SARS on anything just to get, so no one ever can come back. I think what we need to be able to introduce some flexibility in there that we're not, if we're only looking at a very small percentage of the SARS, then having a high standard of 100% accuracy is difficult. So there's some estimates that 15 to 20% of all SARs being filed, which would be 200,000 SARs, are just being filed because people are saying, I don't want the risk of the regulator coming in and saying, I didn't fill the SARs out. And I just think we need to have a little bit more flexibility with financial institutions in that regard.
Thank you. I know that there have been a fair number of questions today about the Community Reinvestment Act, and you've certainly testified about that. And I do appreciate and applaud your commitment to updating these policies. When it comes to reforming CRA, can you address or describe some of those most pressing needs that you see in terms of reforming CRA?
Yeah. First of all, I want financial institutions to do more in the communities across America that need it. And I think in some regards, we haven't created the on-ramp for them to do that. And we've done that by not allowing certain products and services to be counted as CRA, and they just fundamentally should. That's number one. Number two is, I think we have to create a measurement system that, in my mind, allows us to look at financial institutions and be consistent across the size and complexity of the system of what is their commitment to the communities to which they operate. And then the third is we have to be able to turn exams and processes around quicker. And if we can standardize the measurement process, then we can almost have perpetual observations. I believe in the future, people will choose, just like they do entities that are green or do something specific, I think people will choose to bank with people that they think are investing in their communities.
Well, as it does relate to the exams, that's probably one of the biggest complaints that I hear from my financial institutions back in my district. What can you do to reduce the time that it takes to complete the examination or conclude?
I think if we can simplify the measurement method, and you may have been out of the room, but we're proposing a framework where you either take deposits, Tier 1 capital, or total assets, and then you take all the CRA activities that someone is doing, and you just divide that. So you got $100 million in CRA activities, you got $1 billion balance sheet that says that you have 10% of that activity committed, and we can take a small community bank or a large JP Morgan and be able to make a determination. That I could do in about an hour. Instead, we spend these 120 days doing these CRA exams that are very complex, very subjective, and are relative as opposed to absolute in their ability to define what a company is doing in CRA.
Thank you very much, and I yield back the balance of my time.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Tenney.
Thank you, Mr. Chairman, and thank you, Mr. Otting, for being here. We appreciate you, your work you're doing, and unfortunately, I get to be last, so many of my questions are already asked, but I do want to just say a little bit about the Community Reinvestment Act to get into and finish up with my colleague, Mr. Kostov, was talking about. And we do appreciate your looking at finding alternatives and moving banks more in the realm of investing in their communities and also focusing on, not just on the residential side, but on the community side. Can you tell me just a couple of the issues where, enhancing what your answer was to Mr. Kostov, where we can, as, we have national and community banks, but where we can focus some of those banks on reinvestment in our local communities, especially in my region where agriculture is our #1 industry, and dealing with, small business development, because we actually have almost 98% of our businesses in our district and our community are small, and how you would do that is from your position in the as the controller.
Well, I think it's often making what people are doing in the community qualify to be CRA qualified. And as you know, the CRA plan also, extends itself into, the agricultural community. So I think when you think about, I made examples of like where churches are doing things for certain people that's not religious, but it's community building. I think those should qualify. I think businesses that are above $1 million in revenue that, today are blocked by being qualified, that we can make those available to CRA. So I think, and then there's a lot of activities that institutions do around financial literacy that I think those should be included and counted as in the service test as well.
Okay, thank you. And when it comes to the Bank Secrecy Act and the Anti-Money Laundering Act, I know one of the biggest complaints that I get, and I know you've talked about this a little bit, but if you could just enhance, we have a lot of small and community banks, and this is a burden. This compliance cost, they look very small on the larger scheme of things, but when you're dealing with a small bank, you've suggested there are other ways that we can maybe pool these resources or come up with a solution to make it more affordable in terms of compliance. Can you just elaborate on some of that you might have mentioned?
Yeah, I think there's the short-term things that we can do to make it less burdensome without reducing our ability to catch the bad people. And that's partly what we're working with the interagency group. And then I think long-term we have to think through of, like the large banks have their own infrastructures and they can combine data pools with other banks. But most of the small banks use actually third-party servicers. And my thought is that third-party servicer can begin to look at ways that they can help banks look across multitude of institutions to help them identify when there are bad people using multitude of banks, and then alert those banks, the reverse, alerting those banks that we see irregular activity amongst your customer base, as opposed to waiting for a CTR or a SARS to cause that to be identified.
Well, that would be great. Now, in terms of determining what would be a SAR, do you agree that, or disagree? I mean, I'm curious about your opinion on, should we have arbitrary numbers that determine whether we are investigating or looking into the suspicious activity reports? And what's your opinion on that? Should it be an arbitrary number, or should it be just should we look at more like the activity, the other?
Well, there's a floor.
Frequency?
There's a floor on the SARs of $5,000. There's not a floor for any employee-related activity, and we've talked within the agency about raising the floor for, if you have a teller that takes $200, should you really have to fill out a SARS for that? But above that floor, generally what we're asking people to do is, if there's foreign money coming into an account, you should be questioning, if all of a sudden somebody opens up an account and money starts flowing in from, one of the countries that we have concerns about. I'm not sure, when you say there are good descriptors of what is expected to be high risk, and people look at that, and when you see those kind of activities, that's what justifies the SARS.
I'm just thinking frequency. Sometimes they might be smaller dollar amounts and maybe suspicious in another realm, which again, these are all compliance issues again, but I appreciate your willingness to look in and help our smaller regional, and especially in New York, where we have not too many New York banks left that are really able to function in this highly regulated space, because we have a very aggressive regulatory regime coming out of the state. But I appreciate your work in trying to help us and give us some relief on the federal side, because we really are, as we see the economy getting a little more vibrant, we're definitely looking to our banks for more loans and lending and adding jobs. So we appreciate your hard work over there.
Thank you very much.
Thank you so much. I yield time.
Gentlelady yields back. Chair now recognizes the gentleman from Arkansas, Mr. Hill.
Thank the chairman. As a former community banker for over 2.5 decades in my home state of Arkansas, and also a former Treasury official in the ancient days of the Bush 41 administration, I want to thank you for accepting this appointment and serving us as our Comptroller of the Currency. I want to commend you for your effectiveness in developing your budget and looking out for not only the goals of the agency, but taxpayers by actually proposing a reduction in how much money you're able to spend, yet carry out the mission of the OCC. And I want to commend you for the ideas you have on CRA reform and regulatory burden generally by tailoring regulatory burden. So thanks for being with us. First thing I want to raise is, as you know, I'm not a fan of the rule that's now been promulgated, the so-called CDD rule that is to enhance a disclosure of information on beneficial ownership. I think it still has a long way to go. I think I've made those views clear. I think it's going to be the most costly rule probably promulgated in the Trump administration this year, potentially. So one thing that I noted that was concerning that FinCEN issued some relief from was this idea of rollover CDs. So you come in the bank, you buy a CD, you fill out know your customer rule requirements, but then it's on a rolling basis every 6 months annually. FinCEN granted temporary relief from having to refill out and re-ascertain the beneficial ownership. Would you support that being considered a permanent change in the rule, a permanent waiver, if you will, to that on a rollover CD that was properly opened?
It would seem to be prudent, especially if they, did the documentation on the front end of that
Right.
CD.
Yeah, my question assumes absolute appropriate documentation for the account. Thank you for that. Something else that you and I've talked about, just putting our banker hats back on, philosophically, do you agree that banks, when they set an interest rate for a credit, either a consumer credit or a commercial credit, they are trying to price that credit for risk, the credit risk embedded in that transaction? You agree with that?
I do.
And do you agree that local economic conditions are a factor, a parameter in which a bank loan committee or loan officers would take into account in order to set that pricing? You think would that be generally true? In other words, local economic conditions are relevant to the pricing for risk for a loan?
They do in the event that it would impair the source of repayment.
Right. Yeah, I agree too, and yet I'd really urge you in your new role as our Comptroller of the Currency to look at that in the context of consumer compliance laws on lending, where I don't believe that pricing for risk is really permitted. And I'm talking about geographic risk or local industry risk on those sources, where the sources of repayment really could be compromised. I think there's a lot of demand by the regulatory agencies that you can only have one loan price, no matter how big the territory of the bank, for a consumer loan. I'd invite you to look at that. On the Volcker proposal, we've also talked about that before, and you know my strong feelings about harmonizing the interpretation of the Volcker Act. I was very pleased in 2155 enacted into law now that we exempt our community banks from the varieties and confusion and complexity and inconsistency of Volcker for our community banks, and I know you'll be adjusting your Volcker rule as it proceeds for that new law. But when I read the Volcker 2.0 proposal summary section by section, I have to tell you, I found it more complex, less clear. In fact, it posed over 1,000 different court of inquiries for more information or questions, meaning that our regulators are maybe just as confused as they were 8 years ago about trying to come up with a common sense definition for Volcker. Things like the revised definition on the trading account. I didn't find that more clear. Covered funds, which was the whole point, really, if you go back to the legislative intent, it just seemed their proposed rule punted on that, and basically said it's in the too hard stack that people have, and it couldn't be solved. And then the metrics in reporting and record keeping look more burdensome to institutions subjected to it. So we don't have time to discuss it today. I know we'll have a chance to talk about it, but I really urge you as you review these comments, I don't think you're on the right track, and thank you, Mr. Chairman. I yield back.
Gentleman yields back. The chair observes no other members in the queue. Thus, we are prepared to release the witness. I want to thank the witness for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for his response. I would ask Mr. Otting that you please respond promptly as you are able. Now this hearing stands adjourned.
Thank you.